Unfortunately, for the beginning investor, there is no such thing as a perfect stock or bond. No single security offers the safety of the principal, a high current yield, tax benefits, liquidity, and opportunities for capital gains. However, there is good news. We can build a portfolio by owning a variety of asset classes that have characteristics that work together, like the various musical instruments in a band, to give us the investment benefits we're looking for. In fact, the best investment portfolios are built using a diversified mix of asset classes. To remind you, an asset class is a group of investments with similar characteristics. A good example would be U.S. common stocks. U.S. stocks tend to have similar characteristics to each other and different characteristics than international stocks, real estate, bonds, or cash. Within the larger asset class called U.S. stocks, you can own stocks of very large companies called large-cap stocks, mid-size companies or mid-cap stocks, and small companies or small-cap stocks. While all U.S. stocks have similar characteristics, large-cap, mid-cap, and small-cap stocks can perform differently in different market and economic environments, so they each can be considered a separate asset class. Traditional portfolios own a diversified group of stocks, bonds, and cash. Non-traditional portfolios can also own real estate, hedge funds, private equity, and other asset classes that have their own separate and distinct characteristics. Owning a diverse group of asset classes increases the chance that the asset classes in your portfolio won't move in the same direction at the same time, reducing the risk that all of your assets will lose value at the same time in a bear market and increasing the chance that at least some of your assets will perform well in a bull market. It's the old "don't put all your eggs in one basket" philosophy. How you mix all of your asset classes together to invest a portfolio is called the asset allocation of the portfolio, and the choices you make in terms of how much of each asset class you own is called your portfolio policy. If you want your portfolio to appreciate in value, you will own more growth-oriented asset classes like U.S. and international stocks, and less of asset classes like bonds and cash. On the other hand, if you want your portfolio to distribute more current income and are willing to forego opportunities for growth, then your asset allocation will be tilted to owning more bonds and cash and less in stocks. Because we have a lot of historical data on the performance of asset classes, we can make reasonable assumptions about future portfolio risk and return over long periods of time. So when your brother-in-law is giving you his latest stock tip that is sure to make you rich, you can smile and know that while security selection is important, it's how you build your portfolio asset allocation and your choice of portfolio policy that is the most important factor in earning future returns and achieving your financial goals.